Hi, I'm Christine Short, Director with S&P Capital IQ Global Markets Intelligence. In this week's Lookout Report, we take a look at the health of U.S. corporate revenues. This week, we have seen fourth quarter earnings growth for the S&P 500 increase to 7.9%, just about in the 8 to 9% range Global Markets Intelligence predicted at the beginning of the season. With 70 companies left to report, we believe we will easily surpass 8% by the time the season is completed, making this the strongest quarter for profit growth since the fourth quarter of 2011. And while earnings results have been blowing past analysts' expectations, results on the top line have failed to impress. After several quarters of weak revenue growth figures, ranging from the low single digits to the negative growth seen during the second quarter of 2013, we saw third quarter 2013 as an inflection point for corporate sales. During the third quarter, top-line growth came in at 4.1%, the strongest showing since the second quarter of 2012. At that time, analysts expected this relatively strong growth to continue into the final quarter of the year. However, after hitting a peak of 3.6% a few weeks ago, revenue growth is once again lower than expected at 2.8% after a flurry of recent misses. The consumer staples sector is the worst performing sector in terms of revenue performance, with nearly 68% of its companies missing S&P Capital IQ consensus estimates. The biggest offenders are from the personal products and tobacco subsectors, with every company within those industries missing revenue expectations. Following consumer staples is the energy sector, with nearly 55% of companies missing sales estimates. The biggest disappointments have come from the oil, gas, and consumable fuels subsector due to higher operating expenses and lower production volume for many of those companies. Looking ahead, analysts have lowered their estimates for 2014 for each quarter with the exception of the fourth quarter. The overall calendar year 2014 figure has dropped to 3.7% from 3.8%, with the weak spots being the industrials and consumer discretionary sectors, and analysts expecting only the energy, healthcare, and telecommunications services sectors to come out positive for the year. In 2014, we will see the markets focus on corporate revenue growth more than ever. Now that U.S. companies have proven that they can post impressive bottom-line results, the true test of corporate health will be determined by the ability to grow sales. Earnings season continues next week, with 43 companies scheduled to report, many of them retailers. I'm Christine Short, and thank you for tuning in to this week's edition of the Lookout Report.